Hello. Our next video on foundations in audit in ICCA's FIA qualification will be about tests of control. Again, let me remind you that we are basing those videos on express notes which you can download from the website www.theexpgroup.com, and we're in chapter 3, internal controls. That's on page 20. Let us first look at the big picture here. In a previous video, I told you about the risk model and the importance of internal controls. Internal controls is the part of organization's procedures which for the auditor can reduce the audit risk, the risk of issuing a wrong opinion. If you recall the audit risk model, audit risk is inherent risk multiplied by control risk multiplied by detection risk. These two relate to the company. This relates to the auditor. Inherent risk is pretty much objective. The types of transactions, the types of events that happen may lead to higher or lower inherent risk. Control risk, on the other hand, depends on how the organization is set up. Is there a proper segregation of duties? Is there a proper review process within the company? If there is, even if there is high inherent risk, the problems with posting transactions will most likely be detected by internal controls. However, how does the auditor know about that? How does the auditor get the comfort about the control environment within the entity? Well, unfortunately, the auditor can not only rely on their gut feeling or on discussions with management that will assure the auditor that everything is okay. Unfortunately, or fortunately, the auditor has to perform something that is called tests of control. The auditor will need to assess the control environment, perform certain procedures to determine whether internal controls are strong and therefore control risk is low, or whether internal controls are weak and therefore control risk will be high. Based on this, the auditor will decide on their procedures to reduce the detection risk. On page 21 in the notes, you have the overall definition of internal control. You see that it's the action taken by the management to enhance the likelihood that objectives will be achieved. That's the easiest and the most obvious definition of internal controls. Now, if we go down on that page, you will see control activities. This is how internal controls are affected by the company. These are the things that the auditor would expect to be around the financial reporting. The first one, segregation of duties. Very important in order to avoid material misstatements in the financial statements. Very important, for example, to avoid fraud. The most typical, the most obvious, and the most frequently expected control is that the person who makes the payments is segregated or is a different person than the person who enters counterparties. Into payables ledger. or in general the person that posts the payables ledger. Now imagine the situation where this is effectively the same person, right? That person could, in theory, create new counterparties with that person's bank account number, and then all the payments would be made to that person's bank account. That is not really a sophisticated fraud, but you could think of ways of making it more difficult to spot or making it more concealed. So that would be the segregation of duties we would definitely expect in order to reduce the risk of fraud in payables. Where is it more difficult to do? In small organizations. In small organizations, you will always have problems with segregation of duties, right? There's only one accountant that deals with payables, receivables, payroll, and everything. In larger organizations, though, you would expect these two functions to be segregated. The next one is authorization of transactions. Again, the standard procedures in well-established businesses. People do not make purchases and then payments for those purchases just because they want or just because they feel the need. There are purchase orders that need to be properly authorized. Then there is an invoice that is traced to the purchase order. That is what the auditor likes. That prevents errors from being entered in the financial records. Then retention of records. Auditors like something that they call audit trail. That's where all the transactions have a history of documentation behind it. There are no transactions that are authorized orally. There are no transactions that are entered without any documentations. That is a higher level of internal control. Monitoring of operations, again a very important part of internal control systems. Auditors like when managers review the operations of the company on a continuous basis. Let's say they get monthly performance reports, because then the auditors have comfort that if something is posted in the wrong way or there are some significant differences, departures from trends, the managers would be able to spot it within a month. The managers are those who know their business best. So if they suddenly see a drop in revenues or a huge increase in revenues, they see it in their monthly report and they take actions to explain what happened. If this is not the case, the auditor have more work to do because they need to actually check all those variations. Auditors also like physical safeguards. In some cases, take the example of a supermarket. Now, how do you ensure that the staff in the cash POS points don't pocket the money? Well, the easiest way is to have a camera above each POS, and it is the case actually. The cameras above the cash tills in supermarkets are not there to supervise customers. They are there to supervise the cash telling stuff. Also, locks, physical barriers. Consider the warehouse. Because the auditor does give some assurance about the value of inventory in the financial statements, they would have much more comfort to do it if they see a well-guarded and well-organized warehouse rather than when they see an open field with some inventory left there. Again, referring the operations to key performance indicators, definitely the case. That's an example of good internal controls. IT security, a lot of transactions, including those that go through financial reporting, are now managed by IT systems. Obviously, the better the IT is managed, the more comfort the auditor will have over the quality of information in the financial reports. Now, if we go down to page 23 now, you will see another section of this chapter called Tests of Controls. That's part of International Standard on Auditing 330. We know now what internal control is, we know why it is important, and we know what we would expect in terms of best practices in terms of internal controls. Now, how do we test it? How does the auditor test it? On page 24, you have a number of ways in which internal controls can be tested. The first step on this way is always inquiry. This is not really a test. This is much more to get the picture of the system of internal controls, because just by inquiry you can actually determine that there are no internal controls. But if they tell you by inquiry that there are internal controls, then you have to test them. How do you do that? Well, first you can inspect, or sometimes you can inspect documents. That's where you're looking for authorizations, for evidence of authorizations. Usually documents that are authorized are signed, so you're looking for that signature. You can re-perform some control activities. So that may happen when you have one person calculating something, the other person checking the calculation. What you can do is, as an auditor, recalculate what that checking person should have done. And by that you will see whether the person who was supposed to authorize that calculation, whether that person just signed it without recalculating, or whether the recalculation was performed. That's how you check that. You can observe control activities. This is told to be not really effective, because if you observe control activities, it's obvious that people do them properly if they know they're being observed. But sometimes they don't. So you can, for example, review tapes from the supermarket cash tills, and by that you can observe the control activities. You can also perform a very nice exercise of a walkthrough test. So you know what controls you would expect, or you know what controls there should be by inquiry, and then you take a transaction and you walk it through, let's say from the delivery of goods from the client up to these goods being registered in the inventory records, in the financial statements, and you check whether all the control activities were actually performed on this particular transaction. Finally, you've got computer-assisted auditing techniques. They're usually used for a large volume of data and for IT security reasons. Now, last thing to say about testing of controls is the objective of those. On page 22, you can see these two critical objectives. Auditor needs to verify that a control activity exists and that it is relevant. Right? They may be control activities which are not relevant to financial reporting, and the auditor does not need to care about them. However, it's not enough to conclude that the control activity exists, because there is a number of control activities that are written, are put into procedures, then nobody follows. Thus, the next thing is to check that the activity is actually performed. As I say, it's not enough to say that the control exists. It only exists if it is properly performed. And that is why the tests are being there. You could probably determine the existence of controls by inquiry or by review of documentation, by review of procedures, but that's not enough. Then you have to test them to check whether the activity is actually performed.